The financial world held its breath this morning as a structural shift in global wealth and capital markets unfolded in real time. For decades, the concept of an individual net worth exceeding 12 figures existed only in theoretical economic models or speculative fiction. Today, that boundary was breached. As the opening bell rang on Wall Street, the highly anticipated public debut of SpaceX, trading under the ticker SPCX, triggered a frenzy of institutional and retail buying that sent shockwaves through the broader indices. This was not merely another technology listing. It was the largest initial public offering in financial history, a colossal liquidity event that has permanently reshaped the upper echelons of corporate valuation. SpaceX shares, originally priced at an already aggressive $135, opened the day at $150, an immediate 11% premium that signaled immense pent-up institutional demand. By the closing bell, the stock had surged 19% to finish at $160.95. With a single day of trading, the rocket maker cemented its position as the sixth most valuable U.S.-listed corporation, boasting a staggering market capitalization of $2.1 trillion. Behind this historic surge lies an even more profound economic reality. Elon Musk has officially become the world's first trillionaire. With his SpaceX holding valued at roughly $690 billion at the IPO price, and his Tesla equity accounting for another $279 billion, the concentration of private capital has reached an unprecedented scale in modern history. The implications of this market debut extend far beyond one man's balance sheet. On Wall Street, the success of the SPCX listing is already acting as a powerful macro catalyst. Inside the headquarters of major technology firms, a strategic shift is occurring. Highly valued private companies like OpenAI and Anthropic are reportedly accelerating their own plans for mega initial public offerings, seeking to capitalize on a sudden, ravenous market appetite for frontier technology assets. Yet beneath the euphoria, a deeper debate is brewing among veteran economists and market skeptics who warn that this massive valuation is detached from near-term cash flows and fundamental realities. The tension between unprecedented capital expansion and systemic market risk has rarely been this pronounced. To understand these seismic shifts in the global financial architecture, you need deep, rigorous analysis that cuts through the daily market noise. If you want to stay ahead of the critical developments shaping Wall Street, the Federal Reserve, and global markets, take a moment to subscribe to the channel now. By subscribing, you ensure you never miss our analytical, investigative breakdowns of the major economic events changing our world. While the broader indices managed only marginal gains today, and energy markets digested shifting geopolitical risks in the Middle East that dragged crude prices lower, the real story remains the long-term structural changes initiated by this historic IPO. In the sections ahead, we will dissect the timeline that brought us to this critical juncture, trace the flow of institutional fees that enriched Wall Street's elite, and examine the hidden risks that could catch investors off guard. To understand how SpaceX reached this multi-trillion-dollar valuation, one must look back at the calculated decades-long trajectory of its capital structure. Founded in 2002 with the high-risk goal of revolutionizing space transportation, the company was initially viewed by institutional Wall Street as a highly speculative venture dependent on government subsidies and state-sponsored contracts. For years, its survival hinged on securing critical NASA payloads and national security launch agreements. However, as the company systematically achieved reusable rocket milestones and established its commercial dominance, its financial profile shifted from a capital-intensive aerospace firm to a highly scalable, multifaceted commercial platform. In the private secondary markets, SpaceX's valuation climbed at an astronomical pace. Over the past 5 years, private funding rounds repeatedly shattered records, escalating from $100 billion to over $180 billion. Yet despite this rapid appreciation, the company remained fiercely private, shielded from the daily volatility of public equity markets and the stringent reporting requirements of the Securities and Exchange Commission. This insularity created an intense, pent-up demand among retail and institutional investors who were systematically locked out of these exclusive private placements. The decision to finally take SpaceX public under the ticker SPCX was not made in a vacuum. It came at a unique macroeconomic juncture. Over the past 24 months, the Federal Reserve's aggressive interest rate adjustments and subsequent policy plateau had severely chilled the broader IPO market. High borrowing costs and tightening liquidity forced many highly valued startups to delay their public debuts, leading to a historic drought in blockbuster tech listings. Wall Street was hungry for a mega-cap catalyst to revive the primary issuance market and stimulate trading commissions. When rumors of the SpaceX IPO began circulating in earnest weeks ago, the speculation reached a fever pitch. Trading desks globally prepared for unprecedented volume, with retail brokerages upgrading their server capacities to handle the expected deluge of buy orders. Analysts questioned whether public markets, already digesting inflationary pressures and geopolitical instability in energy exporting regions, could successfully absorb a listing of this magnitude without draining liquidity from other sectors. Behind the scenes, lead underwriters Goldman Sachs and Morgan Stanley were quietly structuring a transaction designed to test the absolute limits of public market liquidity. They were betting that the sheer gravitational pull of Elon Musk's brand, combined with SpaceX's near monopoly on satellite internet through Starlink and global orbital launch services, would overcome any macroeconomic headwinds. Today's trading debut proved that their calculations, while highly risky, captured a market desperate for a new secular growth narrative, setting the stage for a dramatic market transformation. The mechanical execution of the SpaceX public debut was a masterclass in market engineering, yet it was not without moments of high-stakes tension on the trading floor. Underwriters spent the early morning hours matching buy and sell orders, trying to establish a stable opening price. While the initial public offering price was set at $135 per share, the sheer volume of buy orders flooding the system delayed the opening cross. When the stock trading under the ticker SPCX finally opened for public trading, it bypassed the initial listing price entirely, opening at $150, an immediate 11% pop that confirmed the massive institutional demand. To understand the strategic importance of SpaceX's public debut, one must look beyond the immediate stock price appreciation and examine its systemic impact on capital markets. SpaceX is not a typical technology company dependent on consumer discretionary spending or advertising revenue. It is a critical component of national security, global communications, and orbital logistics. By transitioning from a private entity to a $2.1 trillion public asset, SpaceX has introduced an entirely new asset class to the public markets, creating a gravitational pull that is already altering the flow of global investment capital. A primary concern for market strategists is the sheer volume of liquidity required to support a company of this scale. In the weeks leading up to the IPO, there were quiet anxieties that the listing would act as a liquidity sponge, draining capital from other sectors of the stock market. Because major institutional portfolios benchmark their holdings against major indices, the sudden arrival of a $2.1 trillion giant forces fund managers to systematically reallocate capital. This means potentially trimming positions in established mega-cap tech companies, as well as traditional defense and aerospace firms to build exposure to SPCX. This massive reallocation has profound implications for market breadth and could inadvertently create quiet selling pressure across other highly valued sectors. Furthermore, this debut has single-handedly revived the long-dormant market for initial public offerings. For the past 2 years, elevated interest rates and market volatility had effectively shut down the pipeline for late-stage venture-backed enterprises. Private investors were unwilling to fund cash-burning growth, and founders were highly reluctant to go public at depressed valuations. SpaceX's successful listing has broken this prolonged logjam. Almost immediately, reports emerged that artificial intelligence giants OpenAI and Anthropic are accelerating their own plans for historic public debuts. The massive institutional support for SPCX has demonstrated that the appetite for frontier technology remains immense, potentially triggering a wave of multi-billion-dollar listings that could completely redefine the modern technology sector. There are also strategic implications for the banking sector itself. The enormous advisory fees captured by Goldman Sachs and Morgan Stanley serve as a powerful signal to the rest of Wall Street. For quarters, investment banks have struggled with depressed transaction revenues, leading to widespread cost-cutting and headcount reductions. The sudden infusion of fee income from the SpaceX IPO, coupled with the prospect of subsequent listings from other high-profile technology firms, is expected to spark a fierce competitive battle among Wall Street institutions to underwrite the next generation of mega-cap listings. In essence, the strategic significance of this event lies in its role as a structural turning point. It has challenged prevailing assumptions about market liquidity in a restrictive policy environment, altered the capital allocation strategies of major institutional funds, and successfully reopened the public markets for the world's most valuable private enterprises. The economic landscape has shifted, and the ripple effects are only beginning to be felt. Throughout the trading session, instead of facing the typical day-one profit-taking that plagues many highly anticipated tech listings, SPCX experienced steady, relentless accumulation. Institutional buyers, eager to secure core positions, absorbed any available liquidity. By the time the closing bell rang, shares had settled at $160.95, securing a historic 19% gain from the IPO price. This price action instantly vaulted SpaceX into the elite tier of corporate giants, establishing it as the sixth most valuable U.S.-listed corporation with a market capitalization of $2.1 trillion. For Elon Musk, the financial implications of this single trading session are historically unprecedented. Prior to the listing, wealth analysts debated the exact valuation of his closely held private shares. Today's public pricing provided definitive transparency. Musk's personal stake in SpaceX was valued at approximately $690 billion at the IPO price. Combined with his existing holdings in Tesla, valued at roughly $279 billion, and other private assets, his aggregate net worth officially crossed the $1 trillion threshold. It is a concentration of economic power without modern parallel, raising critical questions about the influence of private individuals over critical aerospace and global communication infrastructure. Meanwhile, the financial institutions that facilitated this monumental listing secured their own massive windfall. Lead underwriters Goldman Sachs and Morgan Stanley structured the deal to ensure maximum compensation. The two banking giants took home a combined 40% of the total IPO advisory fee pool. This arrangement translates to approximately $100 million apiece for each institution, a lucrative reward that highlights the immense profitability of mega-cap investment banking operations in an otherwise sluggish corporate finance environment. Yet, outside the gravitational pull of the SpaceX debut, the broader financial markets painted a more muted picture. The S&P 500 and the Nasdaq closed only marginally higher as investors carefully weighed the latest geopolitical headlines emerging from the Middle East. Crude oil prices actually fell, reflecting concerns over global demand and shifting supply dynamics rather than local supply disruptions. The stark contrast between the explosive debut of SPCX and the quiet, cautious trading in traditional commodity and equity sectors highlights the unique, isolated nature of today's speculative capital flows. As the dust settles on SpaceX's historic trading day, institutional analysts and academic economists are beginning the complex task of dissecting the company's long-term valuation model. The debate on Wall Street is highly polarized, splitting the financial community into those who view SpaceX as a generational infrastructure asset, and those who warn that the current valuation is a speculative bubble. With a market capitalization of $2.1 trillion, SpaceX is now valued at a multiple that assumes absolute, uninterrupted dominance over both orbital logistics and global telecommunications for the foreseeable future. Many analysts at major investment banks are emphasizing the massive revenue potential of Starlink, SpaceX's satellite internet division. They argue that Starlink represents a near monopoly on high-speed internet in rural and underserved markets globally, creating a highly predictable, high-margin recurring revenue stream. According to bullish research notes published by leading brokerage desks, this subscription revenue, combined with the company's near-total control over global launch capacity, justifies its premium valuation. Proponents argue that the traditional valuation metrics used for defense contractors or legacy aerospace firms simply do not apply to an enterprise that has vertically integrated the entire launch and satellite manufacturing process. However, a vocal contingent of market skeptics and institutional investors are raising flags of caution. They point out that space remains an inherently high-risk, capital-intensive environment where a single catastrophic launch failure or a systemic constellation disruption could wipe out billions of dollars in market value in minutes. Furthermore, skeptics argue that at a valuation of $2.1 trillion, the company is trading at an earnings multiple that leaves absolutely no room for operational errors, project delays, or regulatory setbacks. Some hedge fund managers have quietly indicated they are preparing to build tactical short positions in SPCX, betting that the initial retail euphoria will eventually fade as the company faces the harsh, transparent reality of quarterly public financial reporting. Beyond the immediate stock market mechanics, academic economists are focusing on the broader systemic implications of Elon Musk's newly minted trillionaire status. This concentration of private capital is historically unprecedented, surpassing even the industrial monopolists of the Gilded Age when adjusted for modern economic scale. Critics warn that when a single individual controls the primary means of orbital transport, international satellite communication, and strategic defense launch infrastructure, it creates significant geopolitical and sovereign risks. If SpaceX's corporate decisions ever diverge from national security priorities, governments may find themselves with limited leverage over an enterprise that has become too critical to fail. As the institutional debate intensifies, financial regulators are also keeping a close watch on these developments. While the IPO has provided a welcome boost to market sentiment, regulators remain concerned about the potential for speculative excess to spill over into other highly leveraged technology sectors. The stark divergence between the astronomical valuation of SpaceX and the more subdued performance of the broader, interest rate-sensitive economy suggests that market liquidity is highly concentrated, a dynamic that historical patterns suggest can precede broader market volatility.